Hello everyone, let's start with the first of the three Wall Street stocks. We're looking at Pepsi. On Pepsi, as we can see on the chart, here we're on the daily time frame, the long-term support trend line has perfectly marked all the lows very precisely and consistently. The $130 level was definitely well bought, also with excellent volumes, making it a very interesting level. The price then encountered the resistance area, which we can see very clearly here at $155, where the price was repeatedly rejected. Now we can generally expect a new retracement phase, which in my opinion could offer a great opportunity because this area is a resistance that has worked extremely well. So it could close this remaining gap, and therefore $135 is certainly an interesting area from a buying perspective. This stock is absolutely important in this phase where the indices continue to remain at their highs. Pepsi reached $197 per share, so $135 definitely seems like a great opportunity. Also because we are just above the long trend line we saw at the beginning, which clearly acts as support. So this is a very well protected area. Let's take a look at what happened with the latest announcements with steady growth in some key data points. Beverages in particular, major brands like Pepsi have recorded growth in volume, net revenue, and market share. Of course, as is often the case during earnings season, there are also negative news items. Here we are. Let's translate it with the forecaster. The base volume is influenced by the promotional strategy, and it was affected by a change in the consumer stress strategy. Consumers are stressed all over the world, having to make decisions, facing competition in India, and dealing with a competitive situation in the beverage sector. So margins are definitely under pressure. But again, we are dealing with one of those brands that simply, as they say, when the price is low, you have to take advantage of it. The conference on Pepsi's third quarter 2025 results revealed a mixed picture. Even though the company is facing challenges such as pressure on food sector volumes and consumer caution, it is actively pursuing future growth strategies through innovation, cost management, and so on. Basically, to keep it brief, we all know the Pepsi brand, and well, the stock doesn't seem to be extremely undervalued, but it's currently down by 14%. So if from the current $145 it were to drop to the $135 highlighted in the chart, it would definitely be an interesting situation. Let's take a look at the overview, the tool that shows us how, since the beginning of the year, Pepsi's earnings have declined, while sales, on the other hand, have remained steady. The PE ratio is slightly high at 27. For classic old economy companies like Pepsi, we would prefer it to be at 20. So clearly, in my opinion, investors are waiting for it to come back down, to approach the support area again before entering, and I think closing this gap at $135 could be enough. And moreover, this is a stock that consistently rewards investors, just like its competitor Coca-Cola, because in 5 years the dividend has gone from $1.02 to $1.42, which is almost a 40% increase. So as we said, it's a classic stock to keep an eye on when it offers a pullback opportunity. Let's switch gears completely. Now we're looking at American Tower Corporation. In the real estate sector, a REIT. Here, as we'll see, the numbers aren't particularly outstanding, and in fact, in this case, I want to mention it from the perspective of short-term multi-day trading. Because the support area is in fact a beautiful and well-defined swing area, and we're specifically talking about the price level of $160, which has really been a very important and significant level over time, graphically very, very clean, a level that might not be reached if we consider this support as a valid one that could potentially hold. Clearly, this is a particular sector that has lagged behind a lot compared to others. Here we also have a gap, which, in my opinion, is an entire resistance area that should be taken into account. So, I hypothesize that from the current price of $183, without any rush or hurry, we could eventually reach $160, where the risk-reward ratio is definitely interesting and attractive for looking for a buy opportunity. It's not a stock I like in general. The sector as a whole I do like, but for example, another stock like Lennar Corporation, which operates in the same sector, would absolutely be my preference. It's an important company with a portfolio of about 200. Here it is. Let's translate it exactly with 219,000 communication sites. And it also has a strong value creation component, which is worth mentioning. Overall, the situation presents a number of interesting aspects to consider for investors who are evaluating opportunities in this particular market segment. For the shareholder, the PE is still high, but in general, why don't I consider it as a portfolio stock? Because it's a company with extremely high debt, even though it also has a very high ROE and a profit margin of 35%, so still high. The debt, however, is undoubtedly something to be concerned about if we look at it with the artificial intelligence of the forecaster. You can see here we have the entire earnings conference word for word, and it's often very interesting and enjoyable to see exactly what they say. But here, with the artificial intelligence of our software, we have the recap, which is absolutely important. In this case, what we see is that there are definitely some indisputable growth factors, but essentially the problem is without a doubt the debt, which is probably absolutely concerning. Here it is, NI, return on equity, we can see it. A high ROE is evident, which suggests an efficient use of equity capital. However, the debt to equity ratio is substantially high and indicates a strong reliance on debt to finance activities, which increases financial risk. At this stage, where there is a general debt situation affecting many families, unfortunately, in the United States, it is a sovereign debt, so to speak, that is equally poorly controlled. The real estate sector can be interesting on one hand because it has lagged behind. But on the other hand, if we have such significant debt, this is not the stock I would include in a portfolio perspective. So to reiterate, I actually find it very interesting in the short term at 160 to look for an upward movement. Then there's a stock that is always asked about, requested, and in my opinion, it has an exceptional chart. We're looking at Alibaba. Here it is. So first of all, we had this dynamic downward trend line that was broken nicely on volume. So the trend has definitely reversed. Now, however, a retracement phase has started, which we can basically say has formed a hypothetical descending triangle that seems to have been confirmed after Friday's lows, after Friday's close, which breaks through this area, the base of the triangle, and could trigger an exhaustive bearish impulse. So after the rebound movement, there's a consolidation phase, and then we look for a new upward move. Therefore, the $135 area is a level I really like, both because it was previously a proper swing area, but above all because, here it is, the simple 200 period moving average perfectly coincides with this area. So with Alibaba, there's no rush. Let's wait for it at $135 with a bullish outlook. As we can now say, the trend has been definitively reversed from bearish to bullish. Let's take a look at the seasonality with the forecaster, because the current year 2025 is strongly correlated with the previous year 2024 at 85%. And we see that, for example, those who bought from, let's put it exactly, those who bought from the end of November and held until February last year, the stock had a 45% profit. So with such a strong correlation, we could indeed be in that part of the year when the stock might take off again. It's entering an oversold phase. Here is the market meter, which uses the trended price oscillator, wick-off, and speed. And here it shows us how the stock is still falling and could reach an extreme oversold zone. So it's definitely a very interesting situation. And the overview tool of the forecaster software, which shows us that earnings are still growing while the price is falling. So probably the more the price drops, the more this gap forms. We always use the earnings line in relation to the price because over time they tend to move and resynchronize. So even now we're far apart, and in my opinion, a possible drop to 135. In fact, will definitely make the stock even more attractive. So, in my opinion, it's a definite thumbs up for Alibaba at $135. As always, there's a 20% discount, and you can see how useful it is, for example, to help us quickly distinguish what could be a short-term opportunity from what could be a portfolio purchase. So without having to browse through all the sites, download, study, and especially understand the financial statements, this software helps us work professionally. I think you've seen how much I use it, how truly easy and intuitive it seems to me. I really encourage you to subscribe with the 20% discount. The link is in the description. Greetings to everyone. See you next time.